If I had one last video to make, I would make it a 2 to 3 hour long mini course going over basically everything. And that's what I'm going to do here. I'm going to go over the technicals of my core trading strategy, fundamentals, sentiment, trading psychology, and how to trade with an edge. This is everything that you need in order to generate an income from trading. For those that don't know, I have been trading for over 12 years, traveling and trading around the world, generating an income and helping many other traders do the same. This is not going to be a 10 to 20 minute video going over this simple, easy chart pattern that happens every day, has a 70% win rate, 3-to-1 reward to risk, and you'll be owning a Lamborghini at the end of the day or the end of the week. If that's what you're looking for, simply click off this video. But if you're looking to take trading serious and looking to generate an income, I would recommend listening to the whole thing because I'm going to go over everything that you need to know. So let's get into it. Let's break down the topics of what we're going to be talking about today. Okay, I have a pen and paper and what you can see here about everything that we're going to be talking about in detail, and I'm going to be giving you resources on where to find everything. So I do recommend having a pen and paper and writing stuff down. And if you have any questions, you can always reach out down below. So the first topic that we're going to be covering is basically the technicals, the core strategy. This is what people often think is the holy grail. And so that's why we're going to be talking about the technicals. And we're going to be covering the best markets, time frames that you should be looking at. Should you be day trading or swing trading? And then we're going to be diving into, the core concept of supply and demand, how to identify draw zones, trends, confirmation. I'm going to share with you 1 to 2, maybe 3 different trade setups. Okay, and we're also going to be making sure that we cover entries, exits, stop losses. There's also going to be other things that we talk about when we talk about the core strategy of technicals. I have down here on the screen, such as indicators, other technicals, heat map, and how to properly document a trade. So we're going to be covering that here in the technical portion. And then we're going to be moving on to sentiment. Okay, how to trade and read COT reports, understand where the bank institutions are buying and selling at, basically what their position is, and can we use that in order to create a larger edge. We're also going to be talking about fundamentals. Where can you find these different news events? Okay, how to trade them? What does it mean on the charts? So that's what we're going to be talking about on fundamentals. Sentiment, we just covered that. Then we're going to be going off onto edge. Okay, how to put this all together, technicals, sentiment, fundamentals, making sure that you know how to trade with a proper edge. I've talked about this in different videos right here. Where is this? Okay, if you want to become a profitable trader, you need to consider all these different things into your trading strategy in order to generate an income. So we're going to be breaking all this stuff down, how to trade with an edge. And then lastly, we're going to be talking about trading psychology. A lot of people have problems with trading psychology. It's going to be about a 30 to 40 minute segment talking about, fear, greed, emotional trading, making emotional trading decisions, how to scale, and how to think about risk and probability. So it's a full compact course, little mini course here for you guys in order to make money. I appreciate if you guys like this video. If you have any questions on this, just ask in the comments below, and you can always reach out to me on social media at MoneyballAustin. Let's get into this. Okay, let's get into it. Let's talk about technicals. If you guys don't mind, I did happen to crack an ice cold Modelo here. This is a longer video, and I tend to do this type of stuff when I make a longer video. Have a nice little drink with me, so feel free to grab some tea, grab a cold one. And let's get into this. So the first thing that we're going to be talking about is the technicals, the core strategy of supply and demand. It's important to find a core strategy that makes sense to you. Now, the first thing that we're going to be talking about is the best time frames, markets, and should you be day trading and swing trading. Okay, so let's talk about that. Which time frames and markets should you be looking at? Now, the first thing that I will say when it comes to the core strategy is people often think about this as the holy grail. They couldn't be further from the truth. They're completely wrong. Usually it's a combination of a lot of things and proper risk management, psychology, and that's why we're going to be talking about edge near the end of this, okay? But people often think it's a new beginner's mistake is, oh, I need technicals. No, okay? And we'll talk about this, don't worry. But the first thing that I have written down that we need to talk about is the best time frames that you should be looking at. Now, for most traders, you guys need to understand this. The odds of success are greatly higher if you are a swing trader versus a day trader. This is statistically proven when brokers come out and they do interviews and they release their trading stats for the year, and they talk about, hey, these are what the most profitable traders are doing, and this is what the majority of the losers are doing. And time again, they will actually come out and say, our swing traders, people who tend to hold positions overnight, people who tend to look at higher time frames, tend to have a higher success rate. Those are the stats, and so that's why I would recommend pushing most people towards swing trading versus day trading. I understand it's not as fun and exciting, but it's just the reality. If you want to have the greatest odds of success, swing trading is probably the best bet. You don't even have to swing trade. All I'm going to recommend is getting away from the 1 minute time frame. It doesn't mean you can't make money. I've been doing it for 15 or 12 years or something like that. But I've recently, over the last year, been transitioning to swing trading, but I will still take trades on the 15 minute. No problem. I understand too, lifestyle and stuff like that. If you are working a 9 to 5 job, don't even think about trying to day trade during your lunch break, or, oh, I can trade the London session for 1 hour. Do not do it. Okay, you don't have the time available to you in order to actively day trade. I would recommend swing trading. Like I said, the odds of success are greatly higher. There's less sweeps of price action. You can actually think about a top-down analysis. You don't have to jump into a trade right away, because if you're day trading, you have to be very active. You have to be on the ball and be executing trades very quickly. Swing trading, I could take 2-3 days to decide if I want to take a trade. I could take 30 minutes, an hour, and still get in at a very good price. Versus day trading, boom, you miss it by a minute, you're done. You've missed the trade. Okay, it's very difficult. So that's why I would actually recommend, if you're going to university, you're working a full-time job, stick to swing trading. Okay, but if you want to try day trading, feel free to do it. I would always recommend splitting up the two. Have a day trading account, have a swing trading account, and see at the end of the month or 2 months where you perform best. Where do you make money? Where do you lose the least amount of money? Okay, so that's what I'm going to have to say to that. I recommend swing trading. Now for the time frame sequences for swing trading and day trading, this is primarily what I would look at. If you are a swing trader, I will personally use the monthly, the weekly, and the daily as a higher time frame. I will use both those because sometimes I execute trades on the 30-minute, sometimes I execute trades on the 4-hour. I have a couple live examples of trades that I'm in right now that I will talk about. And so I will use a combination of sometimes the monthly, the weekly, and the daily as my highest time frame. Okay, so those are the time frame sequences that I recommend for like swing trading, using either the weekly and monthly as the highest time frame, and then use maybe the daily potentially as the entry time frame, maybe the 4-hour or the 1 hour. Okay, those are the time frames that I would recommend if you're swing trading. Sometimes I use the 30-minute as well, no problem. If you're day trading and scalping, I would personally recommend 1 hour time frame as your highest time frame, because you're typically going to be in and out of positions within a couple minutes to a couple hours. So all you're really concerned about is what is going to happen over the next 10 minutes, what's going to happen over the next couple hours. So that's why I would recommend your 1 hour time frame being the most important, and we're going to talk all about this. So hold on. But then looking at either 5-minute or 1 minute as your entry time frame. Okay? So those are the time frame sequences I recommend. As for how many markets, if you're day trading or scalping, you should not be looking at more than 3 markets. Okay, do not be looking at more than 3 if you are a day trader / scalper. You can't do it. Every market moves a little bit different, so that's why I recommend looking at maximum 3. For me, it would be like the S&P, gold, and maybe the euro, the dollar. As for swing traders, you're probably going to be looking at maybe 10 to probably 30. Some people look at a lot more, but in my opinion, there's no need to really look at more than 30. I personally only trade 10, and I still get anywhere from 6 on the low end to maybe 15 trades per month. Okay, swing trading. That's totally fine. And if you're day trading, 1 to 3 markets max. That's what I'm going to have to say to something like that. I could go into a lot more detail, but that's all we're going to talk about. So those are the time frame sequences that we're going to talk about and the best markets, and if you should be swing trading or day trading. I recommend re-listening to this. If you have questions, let me know. And let's talk about the core trading strategy of supply and demand. There is no holy grail. That's the first thing that you need to understand. There is no holy grail in trading. It's basically all theories and concepts and trying to make sense of it. Luckily for us, and for myself for many years and many other traders, supply and demand has made the most sense. And so the whole theory and concept of supply and demand is that we are trying to identify where the big money is buying and selling at. And then once prices return back into these levels, we then look to join them. Because what you need to understand is that when you see here, these markets rallying all the way up here, or selling from all the way up here to down here, big money is buying and selling this. They are moving the markets. They consist of basically, the retail traders consist of 1% of the liquidity. Okay, so we as supply and demand traders are trying to identify where the big money is buying and selling at. And then once prices return back into these levels, we then look to join them. That is the whole concept of supply and demand. Luckily for us, they leave footprints on a chart. Okay, and these are typically the 4 patterns that we talk about in trade when it comes to supply and demand. The 4 patterns that we need to talk about are supply and demand. There's 2 supply patterns, 2 demand patterns. The 2 supply patterns is when you have a rally base drop in price and a drop base drop. Those are our 2 supply patterns. Let me show with you another example. Right here, you have a rally up, prices go sideways and then drop. That is a rally base drop. Same thing here, prices rally up, base, and then drop. That is our supply pattern, rally, base, drop. Our drop, base, drop pattern is a continuation pattern, which is when prices drop, strong drop, base sideways, and then drop here again. Okay, that is a supply pattern. So those are our 2 supply patterns. And same thing here, drop, base, drop, base, drop, and a rally, base, drop. Okay, those are our 2 supply patterns. We're going to talk more in detail, but those are them. I wanted to share with you those quick examples. Demand patterns. Let's talk about that. Our 2 demand patterns is when prices drop, base, rally, and a rally, base, rally. Okay, that's it. Prices drop, base, rally, and a rally, base, rally. Let me share with you some more examples of what that looks like. So here, 2 demand patterns. Prices drop, base, rally, right? Rally, base, rally. Those are demand. Same thing. Drop, base, rally, right? And you can see some more here. Here and here, where you got a drop, base, rally, and rally, base, rally. They're very easy to see, and I'm going to help you spot them, don't worry. But what you're going to notice about these patterns is that they all have a base to them. Very simple to identify them. This is why we spend the most time, is because you need to know how to identify them. They have a base, 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 base. These basing candlesticks is when prices go sideways. The base usually consists of 50% candlesticks, which is when the open here, the open and the close of price is less than 50% of the total move. So at one point in time, prices opened here and it rallied all the way up to here and down here, but it closed here. So it closed less than 50%. So that's why we call the basing candlesticks. Typically they consist of 50% candlesticks. Okay, that's when the open and the close is less than the total move, the high and low. Okay, our imbalance, which is the rally for demand, the rally for the demand, and the drop for supply, drop, consist of non-50% candlesticks, which is right here. Notice how prices open here and then close all the way up here. That is a non-50% candlestick, which is called, we call it an imbalance. Not balance, but imbalance. If there is a serious imbalance in price, prices will move very rapidly, very quickly. Okay? It wouldn't go sideways for a long period of time. If there is a serious imbalance between buyers or sellers, it will move in a strong fashion. It's like when you put a top team, say Real Madrid versus a division team, a Division 3 team. They start the game at 0-0. Okay, but by the end of the game, it's 10-0 for Real Madrid because the skill difference is so great. Okay, but if you replace that Division 3 team with Barcelona, then the end of the game is going to be 1-1, 2-1. Those are two evenly matched teams going at it, right? So us as supply and demand traders are trying to identify where these big buyers or sellers stepped into the market. And that's what we are trying to do. That is the concept in theory, is we are trying to identify where these strong moves in the market are happening. And then once prices return back up into them, we then look to trade with them. Okay, and I'm going to describe this even more. So that's what we are trying to do. Those are the four patterns that we look at. But you might be asking yourself, how do we draw that? Okay, let's talk about that. In order to draw these zones, it's very simple. People often overcomplicate this, but all we are trying to do is generally highlight the base. And so one of the examples I give, if you were to imagine medieval times, if you were to go and invade an army camp or invade a castle, you have your army with you traveling to that castle, right? If you were to set up for camp for the night, you would set up the king's tent right in the middle where the king and the generals sleep. You would have the soldiers sleep over here. You'd have more soldiers sleep over here. And maybe the armory, you maybe have a training area and whatever, and then you set the barrier, right? You wouldn't say, oh, this right here is the base, the middle, the king's tent is the base. No, you would say this is the base, right? And that's what we are trying to do, is we're trying to highlight the general base to where these imbalances originated from, which is going to be right here, supply. Okay, we're trying to just highlight the proximal and distal line of the supply and demand zone. So you notice strong imbalance, right? Supply zone. That's all we are trying to do, is draw out the zone, draw out the base, right? So like a demand zone would be like this. Highlight the base. I would not go like this. I would not go like this and say that's my demand zone. No, we're trying to highlight the base of generalization of where the imbalance originated from. I would not go like this and say, oh, that's my base. Oh, that's my base. No, I want to take the general area, okay? And that's what I'm trying to do. So a couple examples here, because I have so many different supply and demand zones right here. Let's just knock it out, and then we're going to go to the live charts. So here, it's a little bit blurry, but work with me, okay? I would highlight this, okay? That would be my base. 50% candlesticks, base, highlight the area, imbalance, right? Same thing, supply zone here, supply zone here. Notice how I'm not going like this, saying, oh, that's my supply zone. No, I'm taking the general area here. That's my zone. Some people might go like this. I probably wouldn't. I don't like making it super big. I would keep it tight and just highlight the general area, okay? Same thing here, like this, okay? Another example for demand zones would be here. I'm not going like this saying that's my demand zone. No, I'm drawing out the base to where the origin of the imbalance originated from, okay? That's that. Same thing here and same thing here, right? In all these zones, I'm just drawing out the base to where these imbalances are. So when we go to a live chart and see this, let's just pick New Zealand, sure. And what you're going to do, any time frame, we're going to change up the time frames, we're going to do all that, but we're going to start on New Zealand daily time frame. Daily time frame, demand is always down and to the left, okay? Down and to the left. And we draw out our demand zone. So we have demand down here, and it looks like we have supply up here and up here. I should draw this out in different colors. There we go. Supply is always above price. Demand is always below price. And we got supply up here as well. So those are my supply and demand zones that I see actively on a chart. Look how I draw it, the proximal and distal line, highlighting the base with a very strong imbalance. Strong imbalance for my supply zone, and up here for my supply zone as well. That's how I'm basically drawing out. I'm trying to draw the proximal and distal line of the base. Now, there's something that we have to continue. You might have asked, well, what about this zone? Well, what about this zone? Is this supply? Is that supply there? Let's talk about that, because one of the biggest mistakes that people will make is they identify poor quality zones, okay? And how do you identify high quality zones? Very important. I feel like I talk about this every day 20 times, but let's talk about it. So we don't just draw out random zones on a chart. What's important is that we are able to identify and draw out high quality zones. Statistically, there is a big difference between the good trades and bad trades. And so what does a good trade have in common? A good level. Number one, a good supply and demand zone will have a strong 2-to-1 imbalance. This means the imbalance, what you see here, is more than 2 times the size of the base. Okay, 2 times the size of the base. That is the first thing. Number two, we're going to go remove opposing ROS, structure, or opposing pivot point zone, structure. What did the imbalance accomplish? What did this zone remove? Think about it as you are interviewing. The example I always give is you are interviewing somebody, or you're interviewing somebody for your job. You have one candidate coming in who never went to school, doesn't have job experience, but wants this job. You're probably not going to hire that person. You'll interview them, but you're not going to hire them. But then somebody else walks through the door. They have 5 years of experience. They've been in this, job sector for 10 years, and they have a degree. Is the most qualified position for the job, right? So you're trying to hire the most qualified position for the job. So there's reason why we put these zones through certain things. And so this is why the number one thing is important. Prices have a strong 2-to-1 imbalance. Okay, 2 times the size of the imbalance. Number two, what did this zone accomplish? Well, those imbalances took out opposing supply zones. It might have broken downward trend lines. Maybe it broke moving averages. So this is a qualified level of demand versus this. What did this level? Don't get me wrong, it's the demand zone. It has a decent imbalance, but it never went 2-to-1. It never took out opposing levels to the left. So it is still a demand zone, but it didn't do anything. I'm not sitting here thinking, wow, this is a good zone. No, it's still a demand zone, but it didn't do anything. We need to be able to identify good zones because statistically, when I look at people's trades, there is a big difference between the winners and losers when it comes to high quality zones. And this is what I'm talking about, high quality zones. High quality zones will, number one, go 2-to-1. Number two, remove opposing structure. Number three, break momentum line, break trend line. So this is when you have, like, say you have a market, let's higher high, higher low, and something like this. Like you had a market where people might think, oh, upward trend lines. Well, this zone here took out this upward momentum line. So an example of that would be like here. Like we would have been able to draw downward momentum as in connecting it to 2 pivot points like lower low, lower high, lower low, lower high. So people might draw downward trend lines. So we actually managed to break that. Now this is the least important, but it's still important, which we will talk more about later. Okay, we'll talk more about this in lesson 2. But hands down, the most important are number 1 and number 2. You want these things to be accomplished within 3 candlesticks. You want prices to go 2-to-1 within 1 to 3 candlesticks. You want prices to remove opposing structure within 1 to 3 candlesticks. If it doesn't mean it's a horrible zone, but a high quality zone will accomplish these things. So that's really what I'm looking for, like this supply zone, this drop-based drop. Look at that imbalance. Look at what in the first 2 candlesticks. Number 1, going 2-to-1. Number 2, taking out opposing levels, making new lows in the market. Okay, that's what I like. I think there was another example like crude oil. Off the top of my head, I just thought about this. Like crude oil, go to the daily time frame. Like we were talking about this being like a really good level. Number 1, super strong imbalance. Number 2, maybe broke through resistance, creating new lows or support. So you broke through support, creating new lows, downtrend, right? So this is a nice high quality level. I like this. It's the same thing if you go down to smaller time frames. You look at these smaller time frames, you would go, wow, look at these supply zones. Supply, a little supply, supply, supply. Number 1, they all have 2-to-1 imbalances. Number 2, they're removing opposing structure. And number 3, they didn't break momentum lines, but still they have number 1 and number 2, which is hands down the most important, okay? So that's what we really want to make sure is that these zones are accomplishing stuff, right? Yeah. Perfect. Yeah, that's why imbalance, imbalance, imbalance. That's the most important. So when I go to a chart, it doesn't matter the time frame. Let's just go like this over one example. Pound. The first thing I do, 4-hour time frame, I draw out my demand and I draw out my supply. That's all I do. That's the first thing that we do on our higher time frame. We draw out levels of interest of higher time frame supply or demand zones. So let's continue on because we got a lot more things to talk about. Let's talk about the recap. Okay, really quickly recap. Recap, number one, markets are dominated by institutions. Number two, all we are trying to do is identify where big money is buying and selling at. We use the 4 patterns to identify that. Demand, drop, base, rally, rally, base, rally. That's it. 2 supply patterns, drop, base, drop, drop, or rally, base, drop. And that's all we're trying to do. And we're trying to highlight the base to these zones, okay? And what you'll notice about the good zones is that they will have a strong 2-to-1 imbalance and ideally remove opposing zones and maybe break momentum lines. All right, we want these zones to accomplish something. So that's why we want to be drawing out good quality zones. If they don't do that, like if you go to a chart and you might be sitting here saying, oh, well, this is a really good 4-hour zone. Well, what did this 4-hour zone accomplish? Tell me. Yeah, it's got a 2-to-1, but it didn't take out opposing structure. It didn't create new highs. It might be a 1-hour zone. Like you go down to a 1-hour, yeah, it's a good 1-hour zone, but it's a 1-hour zone, not a 4-hour zone. Okay, you need to understand that. That's a 1-hour zone, but not a 4-hour zone. So just understand this type of stuff. And there's zones everywhere. Like here, demand, maybe some type of little supply and supply up here. Like there's zones everywhere. But we need to make sure that there's context in which is what you're going to learn in this video. Okay, but that's really what we're looking for. Let's talk about lesson 2. So now that we've talked about that, let's talk about trends and confirmation. Trends really quickly. There are a million different ways to determine trends. Some people will determine trend with Elliott wave theories, moving averages, higher highs, higher lows. It doesn't matter. What's important is that you're consistent with the approach that you take. Okay, because if I go to a chart and I look at this ES chart and I ask you, what is the trend? Sideways. Some people might say downtrend because it's lower lows, lower highs, and they're only valuing what's happening here right now. Well, some people might be looking at this saying, no, look, for the last 3 weeks, we've been range bound, so we're sideways, right? But if you change the daily time frame or weekly time frame, what's the trend? It's in an uptrend. So like, what's the trend? Well, it depends on the time frame that you're looking at, right? You need to understand the trend could be in a downtrend on the 1 minute, but then in an uptrend on the 5 minute, but then in a range-bound market on the daily. And so you need to understand the trend is always different depending on the time frame that you're looking at. And so this is why we have confirmation. And so when we were talking about drawing out zones, it's very simple. The first thing that we do is we are trying to draw out our demand zones below, our supply zones above. And then once prices return back up into these levels or below, depending demand or supply, we then wait for buying or selling opportunities. That's all we're trying to do. So if you understand that prices are coming up into a daily level of supply, what's the trend going to be on a 30-minute or a 15-minute time frame? It's going to be in an uptrend, right? Like look at this. We finally test higher time frame supply. What's the trend? It's in an uptrend. And so you need to understand this when prices are coming into our higher levels of interest. The trend on the smaller time frame is going to be counter trend. It's always going to be counter trend if prices are reacting off of your higher time frame level. But you don't care about that. It's because you understand price turns from inside out. So let's talk about that. And what you need to understand is price does turn from inside out, meaning from smaller time frame to larger time frame. Meaning the 1 minute will turn before the 15 minute, the 15 minute will turn before that 4 hour, and so on and so on. But these prices will turn at higher time frame levels. And the way that I describe it is if you are at the top of the hill, say that's us at the top of the hill, and you have a tennis ball. If you let go of that tennis ball, it's going to continue in that downtrend direction. That's it. and it's not going to come to a stop until it loses momentum. It's got speed of the downward trajectory and momentum behind it, and it's going to keep on rolling. But if you put a tennis ball down there, the same opposing force, do you think that that tennis ball is going to stop this downward momentum tennis ball? No, it's not, because it has downward momentum. It's going to hit it, maybe pull back, and then continue in its direction. It's probably just going to smash right through it, to be honest. But if you replace that tennis ball with a basketball opposing larger force, do you think that basketball is going to stop that tennis ball? Yes, because it's an opposing larger force. And so it's the same thing in trading. What's the only thing that can stop a 30-minute uptrend? A higher opposing force, a 4-hour or daily level of supply, right? What's the only thing that can stop a 1-minute downtrend? A 15-minute demand zone, a 1-hour demand zone, right? It's the same thought process. So we don't mind if prices are now coming back up into our level of higher time frame supply, because prices will turn from inside out. Prices are now testing daily levels of supply. So you go down to a 30-minute, and what's the trend going to be? It's going to be in an uptrend. You're not scared, because what's the only thing that can stop an uptrend? A higher opposing force. And so you have prices testing higher time frame supply. Perfect. What does it do? It starts going sideways and then starts going down. This is what confirmation is. And so what you need to understand is price will always turn from inside out. So the first thing that we do is we draw out our supply and demand zones. Okay? Prices come up into our, say prices are like this and like whatever. Prices are now coming back up into our zone. We then need to wait for selling evidence to step in. What are the evidence that sellers are going to step in? It's going to be number one. Okay, number one. Breaking momentum line. Okay? Breaking momentum line, meaning you're going to be losing the speed of this market. Because before prices come all the way down here, you need to understand that prices are going to go sideways and then lower lows and lower highs, right? So prices will turn from inside out. So the first thing that has to happen is that we start breaking momentum line and taking out opposing pivot point levels of demand. So that's why it's number two. Remove opposing zones, okay? Here, structure. Zones, structure, whatever. This is why we spent the most time on lesson 1 talking about identifying and drawing out zones. This is price turning from inside out. Okay, it's the same thing. If price finally comes back into the level of demand, you have lower lows and lower highs. You're not worried though, because you understand prices turn from inside out. Meaning number one, breaking momentum. Number two, taking out opposing levels of supply and making higher highs and higher lows. That's what confirmation is. That's what we are waiting for when prices reach our higher time frame levels. Guys, I can't stress this enough. This is how prices turn. And that's all what price is prices reach a higher time frame and then turns from inside out. Okay, and I'm going to go over several examples, but this is why we spent the most amount of time on lesson 1. On the first thing, identifying and drawing out zones. Number 2, determining trend and confirmation. Because what you need to understand is once price, let's go, I don't know, what's an example? Let's just go to, the pound's something that I'm short in right now, okay? So what I have right here right now is actually the pound going up into a little weekly level of supply, and then I went down to a 4-hour time frame. Oh, I mean, I have it right here. And look, we have this higher high, higher low, higher high, okay, higher low, higher high, and then boom. This is the confirmation. This is price turning inside out. Okay, that's what I'm waiting for, is the opposing levels to be removed. Let me go like this, like this, opposing levels to be removed, momentum line being broken, and strong quality supply zones being created. That's all I'm waiting for. That's what confirmation is. And we're actually starting to talk about lesson 3 of the top-down analysis now. Kind of segues into that. And then I have a strong quality zone, right? We always need to make sure it's a strong quality zone because there's confirmation everywhere, but we need to make sure that we're trading at strong quality levels, right? It's that simple. It's that simple, okay? So here is a supply zone, breaking momentum, removing opposing levels, and I mean, that's it. Strong quality, 2-to-1 imbalance. That same zone took out opposing levels. It broke upward momentum line. This is why we spent the most amount of time, guys. This is how trends turn. This is the confirmation trade setup, which is now why I'm about to talk about this, and I'll talk about my take profits now when I recap this lesson 2. So let's go back in lesson 2, and then we'll circle back to my take profits. Okay? So, where am I? Lesson 3, lesson 2, yeah, right here. So, number 1, there are a million different ways to determine trend. In supply and demand, we use uptrend, takes out opposing supply zones, higher high, higher low. Very simple. Downtrend takes out demand zones, lower low, lower high. Sideways, it's just choppy. If you're ever looking at a chart and you don't know what the trend is, it's probably sideways. If it's clearly in a downtrend, just lower lows and lower highs, like the most obvious thing, it's in a downtrend. Like, don't overcomplicate it, okay? The Newton's law of motion, okay? That's when we started talking about me standing at the top of the hill. I let go of the ball, right? The only thing that will stop that downward ball in its place is a larger opposing force. So this is the concept of prices now hitting a higher time frame level. We then go down to a smaller time frame and then wait for confirmation. This is the top-down analysis. Like, this is the technical trade setup of what we are looking for. So that's exactly what it is. The first thing I do, go back to that New Zealand. We're going to go back to this pound, but we go back to the New Zealand. Freaking, where is this? Oh, here we go. New Zealand, I go, okay, great, supply, supply. I'm coming into supply right now. I can then go down to a 1-hour time frame and then wait for confirmation. So like here, how we had prices going up, higher high, higher low, higher high, right? Maybe at this point, we might have broken momentum line, but we didn't really take out the opposing level. So I understand why people would not short at this, okay? But they might short at this new level now because this level has a strong 2-to-1. That imbalance also took out the opposing demand zone, right? So I could understand why people would take both, one or the other. So some people might be thinking, I will short that zone. I think that's valid. And some people might short at that zone on the pullback. I think that's valid as well. It really depends. Both are valid, but I would say the second one is probably the higher quality because the imbalance actually did everything. So when we look at the top-down analysis, let me take a quick swig, okay? Is that the right sheet? Number 1, identify zones. Number 2, determine trend. The first thing we ask ourselves, is price inside higher time frame levels? No. Okay, we skip it and we move on. Okay, we'll talk about these other setups later. But do we have confirmation right here? So yes, it's inside higher time frame. Do we have confirmation? Yes. Okay, price is inside our higher time frame level. We have the confirmation. What is confirmation? Price is turning inside out. Take the trade. So let's talk about the pound short that I'm in right now. So this is a short setup here on the pound where I have prices coming back up into a level of weekly supply. Weekly supply. Now you might be thinking like, oh, it's not 2-to-1. I respect that. I respect that. It's not 2-to-1. It didn't. But there's going to be several examples. This is why we're going to be talking about sentiment, fundamentals. You people, I say you people, retail traders think so mechanical. They think, well, it didn't go 2-to-1. It didn't, I can't take the trade. That way of thinking, you lack an edge, a significant edge. You lack the ability to adapt to current market conditions. How do you not know that the banks and institutions on the COT reports are selling this thing 100,000 contracts short? How do you know that the pound didn't just lower interest rates and they see further weakening, right? This is why you have to have context to your trade, which is what I'm going to talk about. But I first need to talk about the technicals. This is what people lack, all right? And I'm going to show you all this stuff, okay? But I'm showing you the technicals. Price inside higher time frame. I then have a strong level of supply right here. Breaking momentum line, opposing levels removed, pivot points removed, not just a regular zone, pivots, okay? Where am I getting out at? I will personally get out at a opposing level of interest. You should never get out at 1-to-1, 2-to-1s, or anything like that. You should get out at an opposing level that will probably, take control, right? So if I'm short this, I have a short take profit of, not a short take profit, but a TP of basically a 3-to-1. I'm basically targeting this level over here is because this is the next opposing level of demand that I'm most concerned about. That's how I'm taking my take profit. That's why I have my take profit down here. Okay, some people might look to get out here at 2-to-1, 1.82 to 1, because this is how far price is left before, and then it returned, and so they might just get out here. I think that's an option. I think some people might take half off. I think some people might have half remaining here. I think some people might have multiple take profits. I think that's all fine. It really depends on the trader, right? And I'll talk about several examples. For my stop loss, I usually just have it above. Sometimes it's structure, sometimes it's volatility based. But in this case, I have it like something like up here or something like that. Basically up here, just above this opposing higher time frame level of supply. So it's basically just a structure stop loss. That's the most easiest. The whole point of a stop loss is at a certain point, when is your trade no longer valid? That's the whole point of your stop loss. Once prices go into my zone, I short that. I'm not waiting for extra confirmation. I could, but I just have a pending order short right there. I enter the trade on the return. That's it. Some people might manage the trade as its lower lows and goes like this. They might move their stop loss to break even. That's fine. There's no best way to do it. Some people will move their stop to break even. Some people will keep it the same. What's important is that you're consistent and that you're not making emotional trading decisions. Okay? I'm going to share with you another trade review because this here, let's go over another trade review. Let's look here. Here on this example, on this crude oil, look, okay, about $1,000 profit. Who cares about that? But the first thing that I would do is I have my higher time frame supply right here. Price is going up into higher time frame supply. I look for selling opportunities. I go down to my smaller time frame and I wait for confirmation. What is confirmation? Price is turning inside out. Very good, guys. Say you have higher highs, higher lows, higher highs, higher lows. Nothing yet, nothing yet. I'm not sitting here thinking, oh, we got confirmation. Nope, nope. It's not till this point here. Strong imbalance 2-to-1, taking out support, taking out demand, that now I have this level of confirmation. That is my short setup. I enter the pullback back into this level right here with my stop loss maybe above structure, maybe up here. Either or is fine. Where is my take profit? My take profit, if I'm getting short here, I'm not concerned about this level. It's already been tested. I'm not concerned about this because it's a horrible imbalance. I would be getting out probably opposing level, which is here. Here. This is my next opposing level. So how do I do this? There we go. I'm going to have my OG, I say it right here, OGTP. But I closed it early because I was getting on a 24-hour flight. So I closed this early because I didn't want to hold it going into Fed rates decision, going into a Trump meeting, so I probably just closed it. That's understandable, okay? But I would get out at an opposing level. And so this is another short. Let's go over another example because that's how you learn is through examples. This here on the New Zealand, is a weekly levels of demand. So I have right now prices coming into a weekly level of demand. I would then go down to a daily time frame and wait for confirmation. Wait for confirmation. I have my lower low, lower high. I have my confirmation right here, and prices turned inside out. So I could enter a trade right here if prices return. Where would my entry be? Probably right here. Stop loss maybe down here, I think is fine. And then my take profit, I would probably, it depends. I think option 1 at this opposing level is fine. But I think that would be a 4-to-1 reward to risk. You're pushing it. I think also a TP here is fine as well. Some people might just close their trade here at 2-to-1. And I think some people might get out at like a 1.5-to-1. It really depends on the trade setup. It depends on so many other factors that we're about to dive into. And that is everything, guys. That's all I'm trying to do when it comes to the technicals of supply and demand. The first thing I do, we're going to talk about, heat map technicals. We're going to talk about that. But when it comes to the pure technicals, that is supply and demand. I draw out my higher time frame levels. I wait for prices to return back into these levels, and I wait for confirmation. That's all I do. Now, there are other trade setups that I might use, like the one time frame setup or the breakout setup. But what you're about to learn is that there's context to these trade setups, which so many traders don't think about, is they lose track of the context of the market conditions. But before we talk about that, because that's when we start talking about fundamentals and sentiment, heat map, trading with an edge, psychology. Now, I did mention there's other trade setups, right? Talking about, the one time frame setup, which is when you don't have price inside higher time frame levels, but trend is in an uptrend, like gold and silver. Like you look at the gold and silver market, this is what the market is. You don't have time in a market condition like this to wait for pullbacks back into higher time frame levels. You got to be aggressive and be more aggressive and look for one time frame setups. They're still the exact same setups that I look for. Like these are the 4 setups that I'll trade. Okay, like let me explain this. The multiple time frame setup is everything that we just talked about. Prices go into higher time frame demand. We wait for confirmation. That's confirmation. We buy the pullback, okay, and we set our TPs and exits. One time frame is the exact same, but we don't need price inside higher time frame. It's the exact same, but we don't need it. But we want to make sure that we are trading with the trend in a serious uptrend condition, like silver, right? Like this, very strong market to the upside. So I might go down to 15-minute time frames, and like this was a 15-minute time frame setup that we were talking about, was this level. Is this level of demand. Now this level, look, still broke downward momentum, took out opposing levels, 2-to-1 imbalance. It did all those things that I ask. It's a very bullish market right now, and so I want to be a little bit more aggressive on those trade setups. There was a supply zone right here that people might think, well, could you short at? Because it looks like on a 5-minute time frame, this 5-minute time frame level here broke momentum line, took out opposing levels, but we're not inside a higher time frame supply zone, so I wouldn't short that. The market's up over 110% for the year. Why am I selling this market? The last 20 trading days, 15 of them have been bullish. Why would I be shorting this for the day? Right? And so that's what you need to understand is there's certain setups that you need to be using during certain times of the day, depending on the market condition. So in the multiple time frame setup, you wait for prices to pull back. The one time frame setup is like more aggressive, but you're trading a more trendy market, which is why I say trending markets trading with higher time frame direction, right? Confirmation 2, it's the exact same setup here as the multiple time frame setup, but maybe you don't get the pullback. Like in this case, you have prices rallying up and then continues. Maybe you don't get that pullback into this original zone. So now you have to look at this trade setup. But I'm still requiring 2-to-1 imbalance, taking out opposing levels, all these things. And then the breakout setup is same technical. It's a range-bound market, and then price is finally breaking above it, breaking out of a range. I wouldn't just trade the breakout straight up. There has to be context to it, okay, which is what we're about to talk about. So in this example, this breakout, there's an example on gold actually. Gold, look. Gold. This gold chart, very range-bound market, okay, very range-bound. And then what did we do? We just broke out to new all-time highs on this gold market. So a lot of people are thinking in their head, let me buy the breakout retest. That is the technical trade setup. But there's other things that you have to consider. And this is why so many traders end up failing. They think, oh, I took the technical setup that appears to have an edge, but they lack context. They lack the market condition. They lack sentiment, all right? And that's what we're about to talk about now, okay? I could sit here and go over so many trade reviews talking about the technicals. That's only going to get you so far. There's more to life than technicals, okay? I mean, I even have it right here talking about confirmation. Like this is literally confirmation. Price go in the higher time frame, prices turn inside out. Same thing, supply zone, right? Turns inside out. It's a little bit blurry, but you guys get the idea. That's how price turns. I don't mind sharing this with you. I'm not trying to hide stuff. It's because you lack the ability to put this all together, which is why people come to me and work with me, is they want to learn that fundamental sentiment psychology. It's very difficult to do it by yourself. But like I said, that's why I have a mini course right here for you guys. Oh, that was great. So let me circle back here into Swiss, into this, and let's double check on everything. Indicators, journaling. Okay, good. We're going to move the journaling section into Edge. That's what I'm going to do. I'm going to talk about the next section now, which is going to be, hold on one second, journal. Perfect. The next section that we are going to talk about is sentiment. This is the holy grail. I love sentiment. What are COT reports? So we're going to talk about sentiment, COT reports. It's one of the most important things that goes into my trading is understanding the positions of the banks and institutions. And we're going to go over a couple trade reviews too. And you can see this photo here. Like, why do I care about the banks and institutions buying this market? So like an example of something like this is you can see here that the banks and institutions, where's this drawing tool? Right here. Look right here. This is why I use COT reports. These guys were short 70,000 contracts. Then they went to 76, 79, 90, 93, 105. These guys are adding to their short positions, the banks and institutions. I ideally want to be selling this thing. And so this is why knowing the banks and institutions, where they're positioned, is so important. I'm aware that the banks are selling this thing. They're adding to their shorts. So what do you think prices are doing on the higher time frame? It's selling off, lower lows, lower highs. This is a daily time frame, right? They're adding to their shorts. So I want to be selling this thing, but I still use supply and demand. Look, nice supply zone, strong imbalance, going over 2-to-1 within 3 candlesticks. The imbalanced candlesticks are taking out opposing structure, right? You can understand the concept of what I'm trying to push here. Price inside higher time frame supply here. Prices pulled back into supply. I have confirmation of this thing turning. This is why it's so important to understand the positions of the banks and the institutions. Are they buying or selling? This is the sentiment report. Okay, and we're going to talk about where to find this. There's a couple ways to find this. If you go to COT-report.com, I'll have it in the description of this video. Go over here to the middle column. I've done videos on this before. It's like a 45-minute video talking about COT reports. I will put it in the description of this video. But after you go to this, it's a recommended listen if you want to learn more about it, because we're only going to talk about this for like 15, 20 minutes. But the sentiment is going to be, I go into that middle column, historical present COT report, simplified, and then I will go to non-commercial, and then I go to currencies. Where is this? Major, and then let's look at, I don't know, which one do you want to look at? The pound? Sure, let's look at the pound. I'm short the pound, so let's look at the pound, for example, okay? And so what can you see on the pound? All right, before I say that, you'll see here, net positions, long positions, short positions. This is letting us know where the banks and institutions, are they adding to their longs? Are they closing their long positions? Are they adding shorts? Are they closing their short positions, right? And then you can see here in the middle column, net positions, are they overall bullish or bearish, that asset? It could be for currencies, metals, stocks, okay? So in this example, I might look at this as net positions. And you can see here, at one point in time, these guys were, let's go here. They've been selling. I mean, right here, right now, you can look. They're minus 80,000, 93,000. But before that, previous weeks, what do you notice that these guys were doing? These guys were overall minus 1,000, minus 6, minus 8,000. They were pretty neutral. So what have they been doing over the last 6 weeks, 8 weeks, 10 weeks? They've been adding to their shorts. So what do you think prices are going to be doing over the last 8 weeks? Selling. So if we go to the pound, what do you notice here? We're on a daily time frame. Since, where is this? Right here. So since September 16th, September 23rd to be exact, they were minus 1,900. And then they got up to minus 80,000. So they were adding to their shorts. So if we go to September 23rd, which is up here, look, this is where prices were on September 23rd. And then what were they starting to do? They added to their shorts. They started selling this thing. And then this is what prices were doing. Lower highs, lower lows, lower highs, lower lows, right? It's selling off. So this is why it's important to understand where the banks and institutions are positioned. What are they trying to do? Okay? So I might look at this and say, great, I might be able to look for selling opportunities. Okay? That's what we are trying to do here. And I see here, adding 100, minus 18, right? I'm looking here on the second column, right? Minus 132, minus 138, right? They were adding shorts. And so ideally, I would want to be selling this thing. But there's a little bit more context to that. I think it's a common mistake that people will look at this and they say, oh, look, short. They're minus 80,000, short. No, because you need to understand, eventually these guys might be taking profits. Eventually, they might be exhausted and they might not touch this thing. Are they adding to their shorts? Are they closing their shorts, as in taking profit? Meaning that might not mean prices are going to skyrocket from there. It means they're closing shorts. And so this is why you need to understand, are they closing their longs? Are they adding to their short? There's context to this about what these banks and institutions, you can't just look at, oh, look, the last week they actually bought. No, there's context to this. And so we'll look at another example of, I don't know, the Japanese yen, sure. The Japanese yen is always interesting. So the Japanese yen at one point in time, they were long back in July 1st, 2025. I'm gonna have it right here. July 1st, 2025. They were long 127,000 position, 127,000 contracts. Okay, so where was that? July 1st, 2025. Let's go to the Japanese yen, July 1st, 2025. That was right here, selling off since then. So they managed to go from 127,000 contracts down to 36,000, right? What was price doing? It was selling off. So you understand the importance of knowing this, okay? And so the way that I will use this is that I will first draw out monthly, weekly levels. And so when I see prices come back up into monthly and weekly levels, I will then wait for buying or selling opportunities, right? Waiting for confirmation. I understand that the COT reports might be starting to change now. now that we're coming back up into a weekly or monthly level of supply, meaning that these guys might start changing their positions. Or if I understand a currency is very weak long term, like the pound that I'm in right now, so the pound, I understand that, hey, number one, we're pulling back up into a monthly, look here on a monthly level of supply. Number two, we're pulling back up into a weekly level of supply. Number three, I have confirmation, price is turning inside out. We look at the COT reports. I look at the pound COT reports, and I understand that these guys have been adding to their short positions. We'll talk about fundamentals in about 5 to 10 minutes time, but I understand the fundamentals is they're a very weak currency. They actually just lowered interest rates today, I believe, the pound. Yeah, they actually lowered interest rates from 4% to 3.75%, okay? Right? And so you can understand the context of why I'm selling this thing now. It's not, oh, it's inside supply, I sell, I got confirmation. No, there's a lot more to this. So I want to share with you some trade reviews on something like this. So on a trade setup like this on the Canadian, all right, technicals. Guys, look, price is coming up into monthly levels of supply. Monthly levels of supply. Would you agree it's a good time to look for selling opportunities? Probably, yeah. We're coming up into monthly levels of supply. We're in a downtrend. Price is hitting monthly supply. I also notice that, hey, look, their positions, COT-wise, minus 71,000, 74, got up to 76, 79,000, minus 79,000, minus 90,000. So they're adding to their short positions, sitting inside supply. I have lower time frame confirmation. Look, higher highs, higher lows, higher highs, higher lows, higher highs. Boom. Right? This is that confirmation I was telling you about. This is not ICT liquidity sweeps. Just buy the opening range breakout. It's not as simple as that. If you think that you can do that, then you could code an EA bot to do something like that for you. But it's never going to work out. Okay, long term, because it lacks market condition. It lacks context to what's happening. And so you look at this supply zone, 2-to-1 imbalance, taking out opposing pivot point zones, breaking momentum line. Everything that we talked about in lesson 1, talking about the technicals, 2-to-1, imbalance, opposing pivot point zones, breaking momentum, it's doing these things. And so I'm going to short the pullback back there with my stop probably right here. I had mentioned it right here, stop loss right here, stop loss. I could have a tighter stop loss, but I had a stop loss up there, okay? Where's my TP? TP, well, I understand before prices returned back here, prices fell, touched this level. So I'm not concerned about it now that I'm in short. I think it's going to remove it. Where would I be concerned about? Well, probably this opposing level. This is nothing impressive. This is nothing impressive. Nothing impressive. This is a large stack of buyers that stepped in from down here. I'm concerned about this level, so let me get out there, right? And eventually, I did. I just don't have it journaled. It eventually did fall, but it was too far out, so I had to keep it relative to showing the confirmation. But I can clearly see TP closed. It hit. I'm walking away 1,000, 2,000, 600 bucks. All right, I'll take that. Okay, something small risk, it looks like that. I'm cool with that, okay? That is the top-down analysis using technicals and COT reports. You need to understand that is what's going on in my top-down analysis. Let's have another example. Okay, so euro. Okay, this euro trade right here. Demand zone. Nice quality imbalance, 2-to-1, taking out pivot point supply. Good quality zone. Okay, one time frame setup. This is what the trend looks like on the higher time frame. Higher high, higher low, higher high, higher low. Pullback, buying the pullback back into demand. And what do I notice on the COT reports? They were previously minus 61,000, 66. They've been buying this thing down into positive territory now. Minus 10,000, positive 15,000, positive 69, positive 89, positive 79. So these guys are adding to their long positions here that you can see here and actually closing their short positions. So it's like a double whammy. These guys are closing their short positions, adding to their longs, buying a pullback back into a demand zone that's qualified. This is a sentiment edge to this on top of my technicals. And so this is how I will use an edge in the market using sentiment reports. I'm not just using technicals, I'm using the COT reports, right? I learn how to understand, are the banks buying or selling? Are they adding to their positions, closing their positions, right? Am I going to be trading against them? Which is okay. Sometimes I trade against them because I'm aware that, hey, we're now hitting a monthly level of demand or a weekly level of demand. They've previously started closing off their short positions before when they were at this situation last year. So now that we're at the same point, they might start closing off their short positions now and actually adding to their longs. And so I could use that for buying opportunities, right? Projecting that they're going to be closing off their shorts like they did last time, right? This is adding context to our trade setups, right? This is why when I say to become the 5%, you have to consider these different things. It's not just about technicals, okay? That's the wrong photo that I'm looking at. I should be looking at sentiment, right? Understanding the COT reports, right? But it's not just that. We didn't even talk about wars, trades, elections, general market consensus. These are all things that have to register into your brain, into sentiment. But hands down, the COT reports are very important. They are the number 2 most important in my trading. But number 1 will always be like the core strategy of supply and demand. That always has to make sense. But then I will also consider number 2, COT reports, okay? So that's where you can get that. I will put that in the description below, and I will also have a video where I talk about this for 45 minutes straight in the description below. So we talked about technicals, core strategy. We're going to circle back on that, don't worry. Sentiment. We talked about how I add sentiment into my trades. We're going to talk about fundamentals now, okay? How do you trade the news? Where do you find the news? How do you interpret it and understand it? Let's talk about that right away. I appreciate if you guys like this video so far. If you have any questions, let me know in the comments below. Okay, so now let's talk about fundamentals. Where to find the news and how to trade/understand the news. One of the most important concepts that a trader needs to understand is fundamentals, because fundamentals, bottom line, is what's driving these markets long term. It's not because prices are reacting off of demand or prices reacting off of support. These markets move long term directionally based off of the fundamentals of that underlying asset. That's what you need to understand. So when it comes to understanding the news announcements for the day, that's something I want you to understand, because this is a very big topic, and I don't want to confuse people, but it's one of the most important things. And the first thing that I want to talk about is where to actually get this data. Where do I read? And one of the best resources I think is zerohedge.com. I will leave a description down below. And they release 4 articles every single day talking about the Asian pre-market, the London pre-market, and the New York pre-market, basically recapping everything that happened over the last 24 hours. And then they also release a daily recap at the end of the close after the New York session. They basically recap everything that happened during that day. And so I have a photo right here of what these articles would look like on Zero Hedge. You got to kind of scroll through them and see what they look like. So actually, if you went to Zero Hedge right now, like you can see it right here. This is the most up-to-date one. So I would look for this photo. You can see right here what it looks like. Like all these kind of look basically the same, and you could just look for this general logo for the Asian, for the European, and then for the New York. So they all basically have the same. And what you could do, click on it, and you could read the recap overall for the day. Overall, it was a choppy day on Thursday, and it will kind of break down kind of like CPI earnings that came out today, bank rates decisions that the euro came out and the pound came out. And it will basically just recap everything that happened in the stock market, individual stocks, the currencies, bonds. It's a fantastic read. And if there's ever one article to read, just make sure it's probably the daily recap, as that will recap everything. But typically, when I wake up, depending where I am around the world, I will usually read the New York session and the market recap session. But if I'm like Asia, maybe I read the Asian session or the London session. But the most important that I think that everyone should be at least taking an interest in is the market recap, is understanding what happened for the last day. Okay, and it'll also let you know like what's happening for the next day and stuff like that. So that's a really good news source in general. I think News Squawk, that's a good one just to understand what is happening for the news for the day. Like not happening for the news for the day, but like if you don't know how to trade the news, they have a nice little thing up here top right, how to trade the news. And if you would scroll down and you could just type in like the CPI, you could obviously use Google on this type of stuff, but it will let you know like what CPI is, and it will let you know like, okay, CPI is basically the cost of goods and services going up monthly or for the year, up or down, right? And how does that reflect the Federal Reserve and their interest rates decision? So that will basically let you know what CPI is. If the positive announcement comes out, as in it's higher than the projected inflation data, then how does this typically reflect the energy market, the metals market, currencies and stocks? And also if it's a negative announcement, how does that overall affect, right? And then they give you a kind of recap, how is this overall used with the Federal Reserve and their bank policy, right? It is one of the most important things to understand. Again, if you read that Zero Hedge article or News Squawk, I mean, it's a partnership with News Squawk. So if you went to like up here in general, pre-market moves and news, it would tell you anyways what pre-market news right here, the market, US Open and that type of stuff. So it's all in kind of one website in general. That is a great news source in general to use. Another major one is Financial Juice. Some people might use that. Forexfactory.com. I use this every single day just to be aware of what is coming out for the day. So if I look today, the pound rates, let me quickly change this so it's just red news coming out. So like today, I want to be aware of the pound was coming out with interest rates. They also kept them the same, okay? The euro also came out bank rate policy where they kept them the same. Sorry, the pound actually lowered interest rates. The euro kept them the same. But also 15 minutes later, the USD came out with CPI data. This is like really important news that actually came out today as I'm recording this video. You're coming out with two bank rates and monthly USD CPI information. It's really important information. And actually in a couple hours, we have the Japanese bank rates. So being aware of these currencies and these news releases of what data is coming out is one of the most important things that a trader needs to be aware of. Okay, is understanding what type of policy that they're in. This is, to be honest, guys, this is a topic that 95% of traders will not find interest in and not think that they need to learn, and is why it's not the main reason, but it's so stupid if you don't understand it, is not take an interest in why the markets are moving in a certain direction based off of these fundamentals and news. You have to understand that this CPI information is reflecting what's happening on the chart for the day on the United States dollar or the stock market or the pound of what's happening, okay? This is what's driving these markets long term. If I was to I could make a 2-hour long video talking about this. It still would go over people's head. It still would. And so that's why when it comes to fundamentals, I truly believe one of the best things that you can do is buy a book on fundamentals. Go to your local library, go to Amazon, find a basic book on trading fundamentals, buy it and read it, because that's going to give you a full-on read on general fundamentals, like what is CPI, how is it interpreted, and it will give you not just like one page, it will give you like 3, 4, 5 pages, and then it'll go to the next one. What is earnings? What is GDP? What is everything on fundamentals, bank rates? What does this mean? Whatever. Buy that book. It's probably one of the best books that you could buy I don't have any recommendations, but just go and find a general book on trading fundamentals that makes sure it covers fundamentals, okay? In general, I think that's one of the best things, and you guys need to take an interest in this. Okay, you can't trade and not understand that there was CPI coming out today. You have to understand that. You don't have to understand the bottom line of everything, what it means, and interpret it, and not wonder why prices aren't going up when it's bullish. You don't need to understand that. You need to be aware of how that impacts the markets, though, to a certain extent. Okay, and if you don't, you'll probably never make money, just being honest. And there's a reason why people don't make videos on this, is because it doesn't get views. And that's probably why, if I looked at the stats of this video, this is the segment where people dropped off or clicked off the most, is because they don't want to listen about fundamentals. They don't care about fundamentals. They don't want to care. They want to know what indicator, or they want to know the chart pattern. They want to know the psychology problem that they have. They don't want to learn about the fundamentals. Most important. So when I look at these trade reviews, right? Oh, we'll talk about trade reviews in a second. Let me quickly recap some of these. Bloomberg, another good one to know about. CNBC, FX Street, feel free to ask AI. You need to start learning about this on your lunch breaks. You have to start reading the recaps, reading books on fundamentals. It's only going to be a positive thing in your trading career. I used to do this when I was working at 9 to 5 as an electrician. On my lunch break, I would pull up the CNBC app. I would pull up Zero Hedge, and I would just read articles on the markets, right? Familiarize yourself with the terminology and the talk of the trading industry. Don't just sit there and think about technicals, okay? I'm going to continue this conversation now, and I want to give a little look at the Edge Finder on stuff like this, because it's one of the most important trading softwares that I've also recently got access to from another trader, Nick. It's his software. I will leave it in the description below. If you guys ever wanted to use this, let me quickly explain on something like this, but it's a really nice indication to why these currencies are rising or falling long term. And I'll give you a quick rundown on stuff like this. So like if I ever looked at the Edge Finder and I was looking at the individual currencies overall, strength, weak, and stuff like that, you look at the GDP growth, the overall economy basically for the United States, or in this case, the pound. Let's talk about the pound because I'm actually short the pound. So the pound is one of the worst currencies, if you guys don't know. And actually recently, they came out and decreased interest rates from 4% down to 3.75%. But then when you look also at the pound, the GDP growth, you can see here that they've been missing completely their forecast overall for their economy. You look here, minus 1%, it actually came out. The real number was minus 1%. The next month, minus 1%. They're missing their forecasted GDP number. They're not producing good numbers, and the pound is looking to decrease rates, and so that's going to devalue their currency even more. And so when you put that in combination with looking at the COT reports of them trying to add to their short positions, right? We talked about how they went from 4,000 up to minus 93,000, recently down to minus 80,000, okay, adding to their shorts. You have price pulling back into weekly levels of supply here, plus 4-hour confirmation. So I have a technical setup, I have sentiment, I have fundamentals to why this thing should be falling potentially. But then also if I look at their forecast of their GDP, their forecast is falling over the next couple months. So these are little things that would increase my edge as a trader. The consumer confidence numbers are not very strong. It's downward trend. They are actually missing relative to the last 3 releases, monthly releases, they are missing their numbers. This is not a good thing for the pound. That doesn't mean the pound cannot rally, but long term, it's going to drive the pound down. Okay, these are not positive things. So you can start to understand, you start combining these things, fundamental, sentiment, technicals together, that's how you're going to create an edge in the market. You look at the pound, the COT reports. You can see, like we talked about before, it's nice to have it all in one software, to be honest. They've been adding to their shorts so that you understand why I like looking for selling opportunities in that pound. And it's nice because you get access to like a couple of years worth of data, 2 years of data, 3 years. So that's really awesome. It's a really good software that I use, and it's something that I would recommend other traders to look into. If you wanted to check it out, I will leave a link down below for you guys to check out. I do have an affiliate code with them, with this Edge Finder A1 Trading, Moneyball Austin or Moneyball. I can't remember exactly what it is, but I will show it on the screen. And you will get a 40% off discount if you guys would like to use that. So this is a great tool just to see visually of this data long term, and you can actually increase your edge as a trader to say, like, do you have the fundamentals, maybe the sentiment and that type of stuff. That's all I really wanted to do a quick mention on something like this, but I use it in order to interpret, help me interpret what's happening long term with these fundamentals in order to trade with a larger edge in the markets. And that's really what I use. Trading Economics is another great one. tradingeconomics.com, I recommend that one. That will give you individual reports on GDP, retail sales, unemployment, all that type of stuff. So those are the news articles that I recommend. Number one, read those articles when it comes to Zero Hedge and New Squawk, right? Pick up a book on trading fundamentals. Forex Factory is another great one to be aware of. Understanding earnings reports. Be aware of the earnings coming out every single day. Some people might use the software or the it's a website called Earnings Hub. That's another good one. But just take an interest in learning about the fundamentals. Everybody is slightly different. Everybody that I know uses different stuff, and they have their own way. Some people look at bank reports. Some people look at Zero Hedge. Some people use AI, ChatGPT to formulate it. Come up with your own style that makes sense to you. And if you wanted to use that software, I will leave it in the description below, and use the affiliate code for 40% off. But when you see these types of trade reviews, because I want to circle back to everything being trade reviews, I would look at what's a trade review. I mean, that was one. You look at the Japanese yen. They were minus 29,000. They bought up a bunch up to 179,000 right here. So they were long 179,000. But then they started selling 176, 172, 167, 164, down to 151. So they are selling their positions, and you can actually see it here. They were long 200,000 contracts, and now they're long 189. And at the same time, they're actually adding to their short positions. Okay? So when I go to something like this, they're closing off their longs, they're adding to their shorts. The Japanese yen fundamentally is one of the worst currencies at the time of this trade. Okay, I say weak Japanese fundamentals, COT, they're selling this thing. There was talks between the United States, trade talks and CPI impacts, okay? And I had this beautiful supply zone, strong and balanced, 2-to-1, taking out levels, breaking momentum line, right? I go back to my technicals on everything like this. So number one is always technicals. Number two, considering sentiment. And then number three, fundamentals, right? Technicals will always be number one. Number two will be technicals, sentiment. Number three will be fundamentals. I don't mind trading against fundamentals because they're long-term movers. Ideally, it is nice to be with them, but I don't mind trading against it. Same thing with sentiment. I'll trade against it if I know what we're coming into an opposing higher time frame level, right? So another example, let's talk about this. There was a good one. I like this one short on crude oil. Okay, here. Yeah, I was looking for it. My gosh. No, we talked about this. Yeah, we already talked about it. We didn't have the COT reports, but when we look at the fundamentals of what was driving this thing, OPEC, okay, they are increasing oil production. The demand is not necessarily there for the oil, and so that's going to be pushing prices to the downside. That's what's driving it fundamentally. So I understand technically we're coming up into supply, fundamentally there's downward pressure to the downside. I have an edge on something like this. It's the same thing on these different trade setups. Like let's look at, so like on the Australian, I might look at this to say, look, sentiment wise, looks like we're adding to our shorts, 69,000. They went up to 100, minus 100,000. You see that? Minus 100,000, adding to their shorts. We are also coming up into daily levels of supply. Okay, I could look for selling opportunities. And I looked like I found an entry setup right here with my supply zone. So I sold the pullback right there, stop loss above here. I lost this trade, which is fine. Okay, I lost that trade. But I understand if I take this trade 100 times, I would probably make money, right? So I have the sentiment. I know I don't have fundamentals. Fundamentals is not necessarily on my side. I even say it right here, JOLTS job numbers, pressure to the upside, stop loss out. The Aussie tops the GDP expectations plus United States poor JOLTS job numbers. So the Aussie released their GDP expectations, which is one of the most important news announcements. They're basically saying we're going to do much better than we anticipated, our economy, over the next year. That's good for the Australian. So that pushes that currency to the upside. And then you combine it with the USD having poor JOLTS job numbers. That's going to devalue the United States dollar, which is arbitrarily going to push the New Zealand up even more. So you can understand how I might have an edge, but this is overall going to push this thing to the upside. And overall, I lose this trade. But that's important, but I made sure to make those notes here that I'm aware of this, so when I review. This is why understanding fundamentals is so important, okay? One of the most difficult things to understand, but you need to be aware of what policy that they're in, what news is coming out, and overall long-term, is this currency bullish or bearish? But it's the least important out of the three. Technicals, number one, sentiment, number two, COT reports. Number three will be fundamentals, okay? Yeah, it's very tough to sit here and talk about fundamentals and for it to make sense very easily. It's one of the most difficult things to understand. And most people just don't think it's a need, but bless their soul, okay? So that's the third thing. I want to talk about an edge, all right? Let's talk about that, and then we're going to be talking about psychology. Because what you need to understand, we've already now talked about technicals, sentiment, fundamentals. We need to talk about putting it all together now, okay? What are you doing? And I've already been breaking it down as we go. Technical, this is what a technical setup is. Okay, now that we know what sentiment is in COT reports, this is how I use it in this trade review, right? And then we talk about fundamentals and I say, look, now let's look at this trade review now that you understand fundamentals. And you can start to understand there's an edge in this trade, all right? Because an edge is what separates you from the profitable traders. And this is why I want to talk to you about becoming the 5% of profitable traders. Very important if you want to make money at this. 1 second. Let me take a swig, and we'll talk about creating an edge in the market. Okay? So, oh boy. What is an edge? An edge is simply a higher chance of one thing happening over another. That's it. That's all what an edge is. And in order to trade with an edge, you have to do things slightly different, which is why we were talking about technicals. And then we were talking about sentiment and how I use that in my trading. And then we were talking about fundamentals and how I use that in my trading. Wow, this is a lot more difficult than you thought. Yes, very good. So, it's a little sarcastic there. But I get messages all the time from people on social media, like, brand new in the trading, they just don't know better. A lot of people get taken advantage of, guys. I've met people all the time that lost tens of thousands, hundreds of thousands of dollars through trading, right? Getting sucked into this game of thinking that they're going to turn a small account into a big account, okay? They lack reality, okay? They lack an edge in the market, and that's what I'm here to share with you. So what you need to understand is the odds are against you greatly if you want to generate an income from this. It doesn't mean it's impossible, but the odds are against you. You look at anything in life, the people that make the most amount of money, they call them the 1%, the 5%. You have to become the 5% if you actually want to make money at this, okay? You have to think and trade differently than the 95%. And we'll talk about that. We will talk about all this. But I first want you to understand this. The stats, 5% of traders are profitable, 3% will ever achieve a prop firm payout, and 1% will ever make more than minimum wage. Those are true stats. And in fact, Top Step even released those stats, a prop firm out there. They even said 100,000 traders, only 12% actually passed the account and 3% ever achieved a prop firm payout. And only 0.1% ever went to a live funded account. What is a prop firm? If you don't have capital, you take a challenge. They will give you an account, a demo account, and if you can pass that, you can then trade live money. Okay? What you need to understand is they don't want you to pass. 99.9% of their income is driven from people failing accounts. Is that good business? I don't think so, but they give you the opportunity if you're a good trader. That's all I'm going to say to stuff like that. I'm here to talk about odds and reality of how to trade with an edge. That's what I'm here to do. Okay? So when we look at this type of stuff, some people will say, oh no, the true odds of success are 15%. Okay, yeah, I'll give you that. 15% of the traders are profitable. But what are you calling a profitable trader? Technically, those people that are deemed a profitable trader is if you are $1 above your P&L. You are deemed a profitable trader. But when you start putting restrictions and variables at bay, where you start saying, okay, well, how many traders have taken over 100 trades? How many traders have been trading for more than 6 months? That number starts to drop. How many traders have made over $1,000? Drops even more. Okay, how many traders have made more than minimum wage this year? 1%. So don't just listen to people say, oh yeah, 15%, 30% are profitable. Yeah, I mean, if they're $1 above their P&L, sure, they're profitable, but they're not outperforming the markets, you know? So you have to understand the variables that people are talking about. And so these are true stats from from firms and brokers, CEOs that come out and say, look, these are the trading stats. Okay? That's what I had to say to something like that. Let's move on to the next thing. Poker players, sports betting players, it's the same thing. 5% will make money, 1% will ever make more than minimum wage. Fun fact, I will pop that on the screen. I'm one of those top 1%. Trading with edge, of course. You can see the little equity graph that I'll show you guys on the screen. Trading with edge, betting with edge. That's what your mind needs to be, okay? And so that's how it is. That's how my brain thinks. I don't think about risk. I think about risk, but I think in terms of edge. I don't think of, oh, price inside demand. Why did I lose? No, I think in terms of edge. If I was to take this trade 100 times, do I make money? Right? That's how I think. An edge is simply a higher chance of one thing happening over another. The reason you're attached to the outcome of the trade is because you're attached to the P&L. I don't give a crap if I win or lose. I manage my risk. I come up with a reason to why I think prices are going up or down. Do I have an edge? Yes, I take the trade. What is my edge? Well, I use a combination of my core strategy with sentiment, with fundamentals. I manage risk. Okay? I use my personal edge of time and experience, building a plan around my own strengths and weaknesses, right? Some people don't like going for 5-to-1 reward to risk, so maybe get out earlier. Some people are very greedy, and so you should have multiple take profits, but maybe have a multiple take profit of a very small risk. We'll talk about this stuff, but this is what an edge is. And so when I look at trade reviews, I look at a trade review. I've looked at this so many times, but I'll talk about it. The S&P 500. I have a beautiful level of demand that prices are pulling back into here. Prices are pulling back into demand. I also note that this demand zone is a strong quality zone. 2-to-1, breaking momentum line, taking out opposing levels. There's an edge there. But what I also notice is the fundamentals. CPI. Today was CPI from the US government shutdown, came out lower than expected. So this was giving the Federal Reserve basically the okay to lower rates in the next 2 weeks. They wanted to see lower inflation so that they could lower interest rates. That would send the stock market up. So they came out with lower interest rates. That's our fundamentals. Okay, technicals. I just talked about technicals. Sentiment. There is no COT reports attached to this, but there's something else. There is something called delta, which we never talked about, which I noticed prices were negative 21,000 delta, meaning there is a lot more sellers coming into this market in pushing sell, market execution. So they just click sell. And each time that they push sell, that is -1. So there's a lot more aggressive sellers stepping into this market that you see right here, right now, as it falls, right? So a lot of people would be scared to enter long, understandable. But I understand eventually these traders need to become buyers. And so I like trying to buy that thing and these guys looking to close their position. But not only that, what do I see on the heat map? What is the heat map? It basically lets me know where active buyers or sellers have pending orders. It will show me if people are aggressively buying this market. And so what I noticed was, okay, we have 1,000 contract buyers stepping in here. We have another 1,000 contract buyer here. So we have a large pending buy order stepping into this market, right? Getting filled. Who is buying this thing? A large buyer that is long 12,000 contracts has been buying this dip. The chances of some trader buying 12,000 contracts and being wrong is probably pretty low, right? And so you get the idea that, hey, we're pulling back into demand, qualified level. Fundamentals also suggest that we should be bullish. We have a different sentiment, as in level 2 buyers stepping in, right? You can understand why that's a good trade setup. It's the same thing in a couple different trades. Let me see here. On the Russell 2000, it looks like I have prices coming back up into 4-hour level of supply. Great, looking for selling opportunities. I went down to a 15-minute and I saw prices higher highs, higher lows, higher highs. Boom, sell zone, right? Confirmation. There is my technical level of setup, right? I like shorting this thing. I'm sitting inside higher time frame supply. I'm setting up in a multiple time frame short confirmation. My entry is going to be right here, enter there. My stop loss is all the way up here, but personally, I probably should have had that thing lower, which is fine. I just trade a smaller position. My TP was probably down here. I have it right down here. So I had my TP down in this area. So probably a 4-to-1, something like that. Okay, great. A little aggressive because you're selling the stock market for sure. Not a smart idea. But I also noticed that here on the COT reports, we're minus 30,000, minus 39. We went up to minus 30, so we actually went the opposite way. But then we went down, minus 58, minus 67, minus 72. Okay, these guys are adding to their short positions. Here, 91,000, adding short, adding shorts, adding shorts again. And they're actually closing off their long positions. So they were closing their longs and adding shorts. So you can understand why I like this position, okay? And then I noticed here, fundamentals. What did I say? Fundamentals here, be as bullish as poor economic news only means lower interest rates, which means Fed would continue to print money, which would arbitrarily increase the market. Yeah. So in this case, I'm trading against the fundamentals. That's a negative, definitely, on my fundamentals. So that's a negative, but I don't mind that. I don't mind that. I still think I have an edge regarding COT reports and technicals. If I only had technicals, I wouldn't short this. I wouldn't do that. I don't think selling a 15-minute trade is a smart idea on the stock market. I think that's a pretty stupid idea. But in this case, I have the sentiment, I have technicals. I'll take that stab. I will take that, and it would probably be good long term. This is how my brain thinks, basically, in terms of an edge. And so it's the same thing when I'm short that pound. We talked about it already, but hey, we're sitting inside weekly supply. Fundamentals are not strong. I have the technicals. COT reports are also showing bearish signs. I believe if I take this trade 100 times, I would be profitable. I understand I will lose 3, 4, 5, 6, 7 trades in a row. I understand that's not out of the equation. But I'm not just trading technicals. That doesn't mean you can't make money, right? Many people will just trade technicals. But what I'm trying to say here is if you just rely basically off of one thing, technicals or sentiment or fundamentals, your edge will be smaller than if you combine everything together. Some people will rely strictly on technicals. That's fine. That you can do that. Some people rely heavily off of their discretion, time, and experience. They read the level 2 data. They read the book map, heat map of looking at pending positions and buyers or sellers stepping into the market. That's good for scalping. They don't care about the fundamentals and sentiment, right? All they care about is what's happening right here, right now on the book map. That's a different way of trading, right? They might just say, oh, look, it's reacting off of demand or support buy, but they rely 99% off of, their time and experience, which is almost impossible to really teach and for somebody to pick up over watching a video. That's why they say, look, I watched this level 2 dome or the heat map for like a year for 8 hours a day, and that's how I learned it. But you're seeing the end result of them saying, look, the buyers are stepping in. And you're like, what? I don't see that. It's because they have time and experience that they're heavily relying off of, which is fine. That's great, right? But these are different ideas. But at the end of the day, if you don't control risk, you'll never make money, okay? So that summarizes our talk about trading edge and how you should be thinking in terms of trading. Don't be thinking about the cap. Don't be thinking about the outcome. Think about, do you have an edge? You do? Take the trade. You lost? Why are you upset? Who cares? You have an edge. Oh, but I lost. All right, let's talk about trading psychology. Good. I'm recording still. This is something I don't want to talk about long term, okay? Is trading psychology. So if we go back here to this home page, I'm still recording, good. We talked about technicals, fundamentals, sentiment, edge, psychology. You can have an edge, but without proper psychology, you will never make money. All right, that is true. I think trading psychology is one of the most overrated things, but it's one of the most important because if you don't have control of it, you'll never make money. It's just true, right? And all it really is your attachment to the amount of capital that's at risk. That's, in my opinion, really what's at play. And I'm going to talk about because the major points of trading psychology that I see people struggle with the most. Let me actually go like this. I'm going to go like this and take this and put it down here just to make it look a little pretty. There we go. Because we're going to be referencing maybe this stuff over here. Trading psychology, okay? One of the most overrated things. I made a 45-minute video talking about this. I will put it in the description below in case you want to watch it, but I'm going to recap everything here in 20 minutes or less. Okay, this is what you're going to do. When people come to me, and I get this people all the time, and they're like, oh, I deal with revenge trading. So stop revenge trading. If you notice that you tend to take a trade and then as soon as you lose, you tend to want to take another and then you lose that and then you want to lose another and then you take another and you lose, you revenge trade, you chase these trades. What do you think about the logical thing is to do? If you come to me and you say, I'm such a good trader, but I deal with revenge trading, as soon as I lose a trade, I double down my risk, I take more and I lose. What do you think the logical thing to do is? Come on, give me the answer. Stop trading, exactly, right? If you notice you have a problem, you need to stop trading. You need to remove yourself from that situation. It's the same example that I tell all the time. If you have problems with doing crack cocaine and you're trying to quit crack cocaine, you need to remove yourself from doing crack cocaine. So you come to me, you're like, oh, I want to quit crack cocaine. Okay, great. When do you do crack cocaine? Well, I like to do crack cocaine at night when I go and hang out with my friends and when I'm in this area of town. Okay, so what we need to do is we need to get you to stop hanging out with your friends. We're going to get you a job, a night shift job. We're going to move you to a different city altogether to remove you from that situation. And I don't know, I forget about the other one, but whatever. We're going to remove you from that situation. We're going to stop you from making these bad habits, all right? Oh, but if I see a really good trade setup, it doesn't matter. According to you, you revenge trade. So we're trying to remove that situation. There's the fix, boom, done. Okay, great. Next, you deal with greed. Some guy that just joined the Moneyball trading program joined. He says he's dealing with greed. He says, I'm good at trading, but I get mad when I get out at a 2-to-1 and prices go 10-to-1. I say, okay, that's great. What we're going to do is you're going to take 1/10 of a position and let that one go to 10-to-1, because you need to understand the odds of these trades going 10-to-1 are maybe once every 8 trades, realistically. Okay? And so you need to instantly just, I want you to take a very small position, get out at your opposing take profit that you wanted to get out at, 3-to-1, 2-to-1, whatever it was, opposing levels of interest, right? But I want you to hold 25% or 10% of the trade, okay? Very small risk, just to scratch that itch of feeling of, being a part of that 10-to-1. Okay, that's what we're going to do. There we go, we fixed it. You have a problem being greedy. Get out 90% of your position, 75, 50%. Have a running take profit. You need to build your trading plan around your strengths and weaknesses. I have my own strengths and weaknesses. You have your own. So this is why we need to build it around your own strengths and weaknesses. Like I said, all right, next. This is why we're speed running through this, because I think it's overrated. I really do. Like, people come to me, oh, I'm scared of being in drawdown. You're scared of being in drawdown is because you have too much capital at risk. That's why. You're gonna lose, man. You don't think people lose? They ain't showing you the results. I'll tell you that much. Let's talk about the next one. Okay, you like to win more than you lose. Okay, get out at quicker take profits. You understand if you go for a 1-to-1 reward to risk or a 0.5, you're going to have a higher win-loss percentage than if you go for a 2-to-1 or 3-to-1, because you need prices to go less in your favor, right? You understand that. If I'm going to get like that pound trade that I'm supposedly in, okay, if I get short this, if I get out here at this opposing TP right here, 2-to-1, there is you have a higher win rate than the trader getting out here than, say, down in here at this level. Right? You guys understand that, right? I don't think most people do, right? So if you are the type of trader that really likes to win a lot, you need to have a smaller reward to risk. It's common sense, okay? Is it optimal? Probably not, but it might be optimal for you being in your mind, but this is why we document our trades in review, okay? Poof, we fixed that issue. We're fixing all the common mistakes, okay? Drawdowns. I just had a trader come to me. How do I deal with drawdowns? Okay, number one, understand drawdowns are just part of the game, right? It's very simple. You're going to be losing trades. You're going to lose 5, 6 trades in a row, 7 trades. You have an average 2.2 R to 1, an average 2.2 reward to risk. You understand you have a 42% win rate. You understand that over the course of 100 trades, you're statistically probably going to lose 8, 9, 10 trades in a row. Like, that's not out of the question. You understand that. So why, based off of those stats, are you so upset? It's because you're emotionally attached to the outcome of your trade based off of the P&L. And this is why I strongly believe if you cut back on the risk, this will solve 95% of your problems. You cut back the risk to a certain point where you don't care about what capital is at risk. You will trade much better. And this is why I would challenge people to lower the risk to something that you don't care about, to the point where you will still take good trades. Okay, you have a problem. I just thought about this off the top of my head. You have a problem of managing your trade. Take the trade, close the computer. Poof, that's simple. Oh, well, I don't know if I should move it to break even. Take the trade, close the computer, come back in 24 hours. You do that over the course of a month, 2 months, boom, you got 30, 40 trades. That should tell you if you have an edge or not. It gets to a point where then if you have an edge, all it is scaling the capital. And if you have a problem scaling the capital, then you need to either lower the risk or start making more money, which is normal. So some people might come to me and they're like, oh, I can trade really fine, but I have a problem risking $200. I can risk no problem $80, $100, but when I hit 200, I start panicking. I understand that. Your attachment to the outcome of the trade based off of $200 means a lot to you. right? Maybe you can buy a lot more stuff. You can buy gas money. You can pay your rent with that. I understand that. It's different for everybody based off of the situation that they might be in their life, right? I risk $200. I don't care. Okay, I look at $200. I don't care, right? Versus somebody else, that could be a monthly wage. Versus me, maybe I start panicking at $10,000. But somebody else that has a net worth of $10 million says, I don't care about $1,000. Their attachment to the amount of money that's at risk is different relative to their lifestyle. So you need to measure, you need to keep in mind relative to the lifestyle that you have and base it around that. If you have $1,000 to your whole net worth, if you have $1,000 to your whole net and you're risking 10%, you're probably you're risking, what is that, $100 per trade? You're gonna panic. You're gonna be closing trades early. It's gonna be a disaster. So what you need to do is get a job, deposit more money, take prop firms, slowly build the account. Start off with $10, $50, slowly build that. As your confidence grows, as you see the results come in, you start building up and risking more, right? It's like, I said it before, guy risks 100, he has no problem. Risk 200, he starts freaking out. Okay, so what we need to do is risk 100, but what we're going to start doing is we're going to start risking 120, 150. You get comfortable with that for 1 to 2 months. Next thing you know, we're risking 180. And then over the course of 3 months, 4 months, now you're risking 200, no problem. But that confidence grows as you see the edge being played out. And this is why I believe having an edge is so important. And your confidence as a trader. People don't have confidence because they don't know if they're doing works. This is why having an edge is important. How do you know you have an edge? 30 to 40 trades will tell you if you have an edge or not. You have a problem moving trades, getting out of trades early, shut down the computer. You have a problem being greedy, multiple take profits, very small risk on the second position. Like, do these things. Build your trading plan around your strengths and weaknesses. And so I want to give you guys a little thing to think about. Action plan, okay? Back test. This will change your mindset in terms of trading. Hold on, I need to get a new one. Cold one, cold one. Oh, everybody loves dinosaurs. All right, back testing. And it's not in terms of back testing that you think. It's going to be in terms of understanding that you have nothing more than a 50-50 chance of being a winner or loser. This will change your mindset, this tool that I'm about to give you. Chances are 99% are not listening to this part of this video. But if you are, this is going to speak to you. Okay. Look, this will change your mindset. This was something from a trader, Nick, oh, I'm going to pooch his name. Nick Sean. But he has this concept that he talks about saying that you need to understand trading is nothing more than a probability of 50-50, right? Prices can only go up or down. It can't go, like people say, oh, it can go sideways. Yeah, but it only goes up or down. It goes sideways, but then it's not doing anything. It can only go up or down, all right? So if you could have a trading edge, if you came to me and you said, oh, I just lose all my trades, my strategy sucks, do the opposite, who cares? Honestly, do the opposite. If you have such a negative edge in the market, just do the opposite of your mentor. Like, I'm being dead serious too. Who cares? You make money, right? It's not about what's fun. It's about what makes you money at the end of the day. Like, I'm just being dead ass with you guys. So this is what I want you to do. I want you to go to a random market. Let's go here. And I want you to back test. Back test where it says bar replay, start new. And this is what you're going to do. You're going to do this for 50 trades, and you're going to realize trading is nothing more than a 50-50 game. I want you to go to a random bar, and I want you just to, if you have a software, you can do this, and I want you to see it for your own eyes because it's different when you see it versus somebody else. Oh, right here. Okay, so I want you to go to a random market, random time frame, doesn't matter, I don't care. And all I want you to do is go for 1-to-1 reward to risk. That's it. And as soon as you exit the position, we're gonna flip it and do the opposite. And if you wanna buy 5 times in a row, buy 5 times. Flip it, go sell 5 times. I just want you to go like this. So we go market execution, buy. We're gonna do the same risk, $100, right? $100, Stop loss, $100 TP. Confirm. I don't even use this, so I'm just guessing it's, okay, so we won. Okay, so now we go like this. Pause. Oops, pause. Okay, now we go market, sell. Do this on yourself so that you guys can see this. We're gonna risk 100, we're gonna go TP 100. We're randomly buying or selling. And you need to understand, trading is nothing more than a 50-50 game. And I want you to do this. Okay, we exited the position. Come on, pause. Let's go sell again, sure. I don't care. This is gonna change your thinking. Confirm. Okay. All right, and we lost something like that. So I want you to do something like that for 50 trades. And what was our overall stats? I think we just lost. I think we won 2, lost 1. And what you're going to notice buying and selling randomly on a chart is that you are a break-even trader. You need to understand that trading is nothing more than a break-even game. This will change your mindset because there's no reason that you should be blowing your account. As long as you have controlled risk, you will never blow your account. You'll never blow your account. As long as you risk 1%, 0.5%, and you never touched your stop loss or never closed the trade manually out early, you should never be blowing your account. If you always went for 5-to-1 trades, you would be a break-even trader. I don't care where you're buying and selling. Do that. Do that 100 trades, go for 3-to-1, you'll be a break-even trader. Message me at Moneyball Austin, I'll pop it here on the screen, and let me know your trading results. And this will change your mindset into thinking that, look, I can randomly buy or sell on a chart and I can at least be a break-even trader. 95% of the traders lose. Probably 70%. 70% of the traders lose. A lot of people are stuck at break-even, but only 5% are able to actually be profitable, right? Okay, maybe like 10%, but you start factoring spreads, commissions, it's realistically like 5%, right? This should change your mindset to the point where you accept that you can't be losing money. This should change your mindset that trading is a break-even game. It is. It's a break-even game. Maybe a slight negative slowly bleed your account 1%, over the course of 20 trades because of spreads and commission. You should realize you lack an edge. You lack an edge. You lack an edge, man. All right? This is why we talk about having an edge. The only reason you're screwing up your trading is because you're letting your mental psychology get to you. You don't know if you have an edge. You keep trading based off of your emotional attachment to the outcome of the P&L. I get it, man. I get it, dude. Anyways, do that. That will change your mindset. Anyways, next, like we said, talk about build your trading plan around your strengths and weaknesses. Everybody's different. Build it off of your own. Risk management, what did I say here? Yeah, we talked about this. Build risk management for 1 to 2 months in order to see if you have an edge. This is why you should be documenting your trades. Document every single trade. It drives me crazy, guys. It drives me absolutely bonkers when I see traders come to me and they're like, I'm losing money. I go, great. We're going to review all your trades. Send me the last 20 trades and we're going to review them in our Wednesday meeting. This is something I do with traders in the Moneyball trading program. I work with them one-on-one in order to find an edge and trade with an edge. Fundamentals, technical, sentiment, and all this. Like, this is like what we do. And we talk about, like, do you actually have an edge in this trade? And after 30 to 40 trades, I sit down with them and I review all their trades. And I say, look, I like what you did here, 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 and I don't like what you did here. I work directly with other traders, right? I like to work with them one-on-one. And if they say to me, oh, I'm not making money, I go, great, send me the last 30, 40 trades, and we're going to sit down in our Wednesday meeting, and I'm going to go over all your trades. And they hit me with the, ooh, I didn't journal my trades. Ooh, I didn't document my trades. I know you tell me all the time, make sure you document your trades. In fact, look, I'm doing this live here. I even said it right here. Oh, look, this guy, D, okay, this guy posted a trade review and I said, okay, document, and after 30 to 40 trades, we'll see how this performs. Like, I'm literally telling this guy, just document the damn trade. So if you come to me in 30 to 40 trades saying, I'm not getting good results, I go, great, Let's review. I don't know if you're doing anything good. Maybe you're doing something completely negative, right? That has a negative edge. And I'll be able to see that. I've got 12 years of experience. I can tell if you probably have an edge or not, right? I can spot what is a good trade setup and what is not based off of time and experience, based off of seeing the fundamentals long term, based off of looking at the COT reports. This is why documenting your trades is so important, because how do you actually expect to get better, right? And understand what's working and what's not. And if you don't, you'll probably just never make money, right? Every trader that I know documents their trades to some extent, whether it's just a general picture or a full-on top-down analysis, like that you see here me going over, right? Now here, I try to document all my trades like this, right? Because the more that I can document, the better that I can review. And I can learn from these mistakes and learn from what's working and what's not, right? That's what's important. And I get it. There's a lot being thrown at you over the course of this video. But this is what I'm telling you. This is what is required to some extent. Some people will rely more off of technical. Some people will rely off of more personal. Some people will rely heavy off of sentiment and COT reports. And some people, more long-term investing, will just rely off of fundamentals, and that's all they care about. Like, you could become a profitable trader with just one of these things. You could totally do it. But without the proper risk management, you'll never make money. Without the proper psychology, you'll never make money, right? This is why I believe psychology is one of the most overrated things. As long as you could control risk and not give in to the emotions, you'll be at least a break-even trader. The question is, do you actually have an edge in your trade setups, right? And this is why I work with traders, right? This is why they come to me and they say, man, I've tried everything. I've joined other people's programs. I've worked with people only to get treated like another number. They're like, yeah, there's 1,000 18-year-old children, and they're acting like children, gambling. Or they're not getting, directly coached like they were promised. They said, oh, you're going to get coached. But then there's 1,000 other people. How do you expect to get coached with 1,000 people? I try to work directly with every trader one-on-one, and this is a trader that just did this. And I even just said, what did I say? Yeah, this guy's handing in homework. And I said, look, you didn't even hand in the correct homework. So this guy was handing in homework on homework 3. And I was like, listen, dude, you didn't even do anything for homework 3. So I need to give this guy feedback. Does he actually understand the top-down analysis? You understand what I mean? Like, hand in lesson 1, lesson 2, lesson 3. That lets me know that you understand each concept before moving on to the next. Because lesson 2 builds on lesson 1, lesson 3 builds on lesson 2 and lesson 1. Right? And then after you have 30 to 40 trades, let's do a one-on-one and let's review, right? The problem is most people, want that get rich quick, right? And that's why I like to tend to work with those more serious traders that are looking to, make a more realistic return of, generating maybe 2 to 5% per month, maybe 7% per month. Really depends on how much you're willing to risk per your capital at risk, right? You risk more, you make more. You risk more, you lose potential more. You risk less, you make less. So it's the same thing, right? But at the end of the day, it's probably one of the best trading careers that you guys could get into is trading, swing trading, day trading. But without this, without having proper, if there's one thing that you guys get out of this, having a proper foundation of fundamental sentiment, technicals, personal edge, without risk management, you'll never make money. By all means, go off and watch your trading live stream. I don't care. Just don't tell me about it, okay? I don't care about what you're doing. I like to work with serious traders. I like to work directly and build a relationship with those traders, okay? But if there's one thing that you get from a video like this, is maybe it's fundamentals, maybe it's understanding different ways of thinking, maybe it's building a plan around your strengths and weaknesses, maybe it's realizing that, hey, I do want to work with a direct coach who's going to be there and help me out. Right? And I would tell those traders to look at joining the Moneyball Trading Program. And so if you would like to work with me on something like that, we do have something with the Moneyball Trading Program where I work directly with traders. I will leave a link below in the description for you guys to join. You guys can always reach out to me on social media at Moneyball Austin. It's no problem. Right? I message everyone. There's no AI bots sending you anything. You guys can always reach out to me in the comments. Okay? I appreciate if you guys like this video. It's the holiday season. We're going into 2026, and you guys need to start thinking differently about your trading. What are the 5% of traders doing versus the 95%? You guys need to start thinking differently, and doing different actions. Everybody's goal was 2025, I want to make money. They're in the same spot, still losing money. Okay? They're not doing this. They're not trading with an edge. They don't think in terms of trading as nothing is more than a break-even game. So, you know, I'd love to work with you guys, man. I'd love to work with you guys. I like to work with serious traders. That will all be in the description below. Feel free to reach out to me on social media at MoneyballAustin. Anything that I mentioned in this video will be in the description below. Okay? Links to Zero Hedge, links to a 2-hour-long video going over my core strategy, fundamental video, sentiment, COT, that will all be individually marked out. So check out one of those videos that interest you, and I will see you guys in the next one. Cheers. Bye-bye.